Well, hello, welcome. We're delighted that you're here. We're going to begin our program. This is the 2025 Economic and Investment Outlook presented by Dechtman Wealth Management. Our format is just slightly different this time. We're encouraging any questions that you might have, but we would ask if you can email any questions that you have to info@dechtmanwealth.com. info@dechtmanwealth.com, and that way we can get through all of the information in our presentation. Everyone is familiar with the important disclosure information. So I do want to make a few comments about our discussion here this evening. First of all, I would encourage you to grab a pen and paper. And this way, if you do have questions or anything that you want to get back to us on, we will definitely be able to get back to you. But please jot it down and let us know. Secondly, the presentation is approximately 45 minutes, plus or minus. Again, we'll save time for any questions at the end. Email us at info@dechtmanwealth.com. All right, we have a very full presentation today, and here is our agenda. Will the bull markets for stocks continue? Secondly, economic and investment implications of the new administration. There are major changes to Social Security, and we're excited to share that with you. Interest rates, housing, and the Federal Reserve. What does that mean for you going forward? And last, we have some exciting investment and planning opportunities that we want to share with you. So on that note, I'd like to turn it over to Sam to take us through the next step.
All right. Thank you for that introduction, Jordan. And the first topic we're going to talk about is, will the bull market for stocks continue? 2023 and 2024 were very good years, but we continue to see that trend move forward here into 2025. When we're doing our investment analysis and we talk about the fundamentals, what we're really talking about is corporate profits, or earnings is another way to put that. Over time, as companies are more profitable and their earnings go up, you generally see the value of that business continue to increase. So focusing on not only what the profits are today, but where we expect them to be in 3, 6, 12 months and beyond is incredibly important. So on the left-hand side of this particular slide, we're looking at forward earnings expectations over the next 12 months for companies within the S&P 500. And as you can see, pretty much here at the low point at the end of 2022, is you've started to see earnings expectations go up. And if you might remember the comment that I just mentioned earlier, 23 and 24 were very good years. So it's no surprise that we saw earnings expectations go up over that very same period. And at least based on what analysts are suggesting at this point, they view earnings to continue going up in 2025. So earnings aren't the end-all be-all, because emotions do play into how stocks trade on a short-term basis, but seeing earnings continually going up as well as raising expectations is something that we're very encouraged about. And 2024 ended up being a great year, not only from profits, but massively outperforming what the expectations were. On the right-hand side, you're seeing a chart which goes over profit margins. Now, just to put it simply, this chart is about efficiency. So on the left-hand side, we see the raw data in terms of how the earnings are going up. The right-hand side tells you that companies are earning these profits at a more efficient rate. Now, why is that? We're starting to see a lot more improvements with worker productivity. One of the main factors in that is AI. AI has started to become more prevalent in the last couple years, and we expect that 2025 it'll take another giant leap forward in terms of making your existing employees that much more efficient and that much more productive to continue earning profits. And so not only is it encouraging that we're seeing earnings go up, but we're also seeing profit margins go up, which lead us to believe that there's still room to run here and that the stock market it is in a healthy place. Switching gears, or actually one more comment that I wanted to make about corporate profits too. So we're going to be getting into this in a couple slides, but I think it's important to introduce this now. One of the things which is not factored into earnings expectations or profit margins is the idea that one of the tax proposals that is being thrown out there for corporations is lowering the corporate tax rate from 21% to 15%. This is just in the proposal stage. It has not been signed. It is not moving forward. But if you are to see the corporate tax rate decrease from 21% to 15%, we do think that that would have an immediate effect on the bottom line for the profits of these companies, which we think could be another tailwind. So now switching gears and looking at the consumer, we want to know how are individual households doing. Now, what this particular graph shows us is the debt payments as a percentage of disposable income. So this is not properly factoring in how inflation has impacted households. Instead, this is looking at how much of your disposable income is going towards paying debt. Roughly 70% of US GDP is based on consumer spending. And if consumers are still in good shape and spending, you generally see the wheels of the economy moving in a positive direction. And so we want to see, okay, is the consumer still in a good spot to spend, or are they becoming a little bit too bogged down in debt? So if we look at the right-hand side of the screen, we can see that we're at about 10.1% of someone's disposable income is going towards mandatory debt payments. So that's your mortgage, that's your car, that's your student loans, credit cards, whatever it might be. And you could see that it's significantly below where we were in 2007, right before the great financial crisis. And we're really at a low point that we've seen, other than the dip here in COVID, going back 40 plus years. So even though we've seen the cost of goods and services go up, consumers aren't overextending themselves at this moment in terms of debt, where they can go underwater. However, cracks are starting to show lately. What we're looking at here is the increase of debts that enter delinquency. Now, this is a little bit of a busy chart because you can see all different types of debt, but the one that I want to focus most on is the yellow line that's traversing across the screen here. This is mortgages. Mortgages represent by far and away the largest dollar size of debt that is outstanding for consumers and is by far the most important of all of these. And what you're starting to see is that mortgages are beginning to creep up a little bit. They hit a low point here when you had mortgages in some cases forbearance for a little bit of time, and then they've slowly started to tick up. So we want to keep a very mindful eye on what's going on with mortgages. But I'd be remiss if we also didn't talk about credit cards and auto loans, because we're starting to see those two, the blue and the green line, begin to creep up. So overall, based on the last slide, collectively, things are looking better, but at least for delinquencies in the last 30 plus days, we're starting to see things tick up. So cracks are starting to begin to show up, so we're going to need to keep a mindful eye. And I know this is something that the Federal Reserve is keeping a watchful eye on. Next, we're going to shift gears entirely and talk about economic and investment implications of the new administration. And we want to be very clear. We are not saying if policies are good or bad. We're not saying if the way they're executing on them is good or bad. We're merely sharing what is happening at the moment and giving you our objective analysis on how this impacts you and what we can expect going forward. So the first topic that we want to go over is tariffs. And tariffs has been a major topic of the Trump administration, even going back to the Trump 1.0, the first time that he was in office. Shortly after Trump was elected this time around, 25% tariffs were levied on Canada, 25% tariffs were levied on Mexico, and also 10% tariffs on China. Shortly after the tariffs on Canada and Mexico went into effect, they had reached an agreement where they decided to postpone those tariffs for 30 days. And so at the moment, both of those are in this 30-day waiting period. So we will have to wait and see what happens over the next couple of weeks, if they're able to come to a final resolution, or if the tariffs are going to be put in place, or if there's going to be some sort of adjustment. Related to China, after the 10% tariffs that were put on China, they ended up retaliating and putting some tariffs on American goods. To the best of our knowledge, we're not quite sure where that is. It seems to be at an impasse at the moment. And then another tariffs were 25% that was levied on steel and aluminum imports. So a question that we're often asked is, are you worried about them? Is this going to cause inflation? How do we really think about tariffs going forward and the impact for our portfolios? And it's a little hard to answer because each of the different tariffs based on countries or goods impact the economy and the portfolios in different ways. But let's first talk about Canada and Mexico. Canada exports 77% of their goods to the United States. And with Mexico, it's somewhere in the 80%. We are by far, both of those countries' largest trading partners. And second place is not very close. And so our belief is the reason why these tariffs are put on in the first place is due to the outside leverage that the United States has. And so, right or wrong, again, we're not making that case at all. We're merely just sharing the data that it does seem like the U.S. has significantly more leverage with both of those countries. So we will have to see what ultimately happens in the next couple of weeks before those tariffs are put back in place if there's a resolution. But it does seem like Canada and Mexico will need to acquiesce to some of our requests. Now, in regards to the inflation picture, I would say that we are not as fearful as some publications or prognosticators have led you to believe. So let me go through. And so generally, inflation over time is most closely correlated with the money supply. So if there is no change in the money supply, then we don't really see tariffs having too big of an impact when it comes to inflation. So let me give you an example. Let's say with your disposable income, you have $100. And normally you are buying bananas and they cost $5. So after you purchase bananas, you have $95 to spend on everything else that your heart desires. But then a tariff is put on those bananas that we're importing. And let's say it's 100% tariff. So now instead of spending $5, you are spending $10 on those bananas. What that means is that you only have $90 to spend on everything else. So the cost of those bananas doubled. It went from 5 to 10. But ultimately, you have $5 less now to actually spend on other goods and services. So unless there is a dramatic increase in the money supply, we don't see tariffs having too big of an impact. And we actually have a very recent example. The last time Trump was in office, tariffs were a major part of his platform, particularly with China. And over at least the first Trump term, the inflation rate was just a tick under 2%. And so as long as there's not a major increase in the money supply, we don't see tariffs having an impact on the overall economy. Now, they're certainly going to impact the goods that the tariffs are levied on, but we don't see major contagion happening from that. Another initiative that was talked about during the campaign trail and one that is being debated in Congress right now is proposed tax changes. Last time Trump was in office, Congress had passed what's called the Tax Cuts and Jobs Act. And what that did is that lowered all of the individual tax rates to where they're currently at. But the thing was, those changes were not permanent. They were temporary, and they actually end at the end of this year. So Congress really has no choice but to come up with a plan on what they're going to do with the individual tax rates. Last we saw and were reading about, it looked like they were talking about extending the current tax rates at their current levels. We'll have to see what that looks like in the long run. It might be just another temporary fix, or it might end up being permanent. But the discussion right now is at least to extend the current tax rates as they are instead of letting them go back up. Another major proposal that's being discussed, and this will be helpful for a lot of our clients here on the line today, is no tax on Social Security benefits. Right now, up to 85% of Social Security benefits are taxable at the federal level. So this change would be pretty significant. It would reduce it to zero. And at least right now in the state of Colorado, if you are over age 65, none of your Social Security is taxable for Colorado state income taxes. So you already have that benefit. Another major increase or change rather would be an increase in the SALT deduction. What that stands for is state and local tax deduction. So depending on how much you pay in state and local taxes, you can deduct up to $10,000 against your federal tax payment. So right now, a part of the proposals is to increase that number. So if you are a high earner, this is something that you're certainly going to benefit from. The last bullet point here I briefly touched on in a previous slide, which is lowering the corporate tax rate from 21% to 15%. We are optimistic about what this could hold, particularly for corporations. And in turn, we do think that, and the hope is that individuals would benefit from this as well, whether that means they're going to hire new employees, whether they're going to lower the price of their goods. Ultimately, corporations are going to have a lot of decisions to make if they become more profitable by way of paying less in taxes. Another major initiative of the new administration is to get a handle on the United States fiscal situation. Every single year, the United States spends more than we make. And when we spend more than we make, that is referred to as a deficit. And in order to fund this deficit, what we have to do is we have to borrow. So the United States Treasury issues bonds so we can pay those bills that we are ultimately paying on. So what we're looking at here on the right-hand side of the graph, right-hand side of the chart shows what the deficit has been going back to 2000. And if you look over the last couple of years, the deficit is roughly around $2 trillion over the last couple of years. The full year deficit for 2024 came in at a little over 1.8 trillion. And yes, that's trillion with a T. And so this is really an unsustainable path that we're on. And so let's take a look at what this looks like from a breakdown of where the money is being spent. So based on the fiscal year 2024, these were the top 4 line items: Medicare, Social Security, National Defense, and then the last one, which is one I want to highlight here, interest on the national debt. I know there's a lot of commas in here, so we'll just simplify it. In fiscal year 2024, the United States paid 1.1 trillion with a T dollars just to finance the interest on the national debt. That is extremely important because the expectation, what the projection is for 2024, is that the interest on the national debt is going to leapfrog national defense in terms of how much we're spending on it. So getting this under control is an imperative because the interest on the national debt is just continuing to get bigger and bigger. And one of the reasons for that is during COVID, when interest rates were so low, the United States was able to borrow at lower interest rates. So as some of those bonds are maturing, we're having to refinance at higher interest rates from where we're at now. So even though we may not be putting on any extra debt, the interest to finance that very same debt is continuing to go up. So when you have a year where you spend more than you make, that's the deficit. When you add up all of those years together, then that becomes the national debt. And you can see how significantly it's changed since the beginning of the 1900s. As of the end of the fiscal year 2024, we're at over $35 trillion. And as of this moment, we're over $36 trillion. So this is becoming massive. Now, when we look at it from a historical standpoint, we want to know, what does it look like from our national debt to the GDP? And so the projection right now is that the federal debt is going to surpass 100% of our GDP for the first time since World War II. So getting the debt under control, getting our deficits under control is a massive imperative for everyone. Now, again, we are not here to comment on how they're going about doing it, what is being cut, the execution of those cuts. The point that we're trying to make is the United States does need to find a way to spend what we make, just like any household would, where we don't want to continue borrowing and borrowing and borrowing, because one day, somewhere down the line, the investors may say, I'm not very interested in buying this debt anymore because I'm not so sure that you're going to be able to pay it back. And when that happens, then the government says, okay, well, we can just print money. But we all know what happens when you just print money. It increases inflation. So you have a very self-defeating spiral that comes when you don't get this under wraps. So again, we just want to make the point here that we can argue and disagree about what should be cut and how it should be done, but a point that I think hopefully everyone can ultimately agree to is that we do need to find a way to get the deficits under control, and then hopefully we can find some way to start paying down the debt by having surpluses. And on the right-hand side of this graph, you can see what the Congressional Budget Office, the CBO, projects, what the Federal Reserve projects, and then the green line is a more optimistic assumption. But maybe if we just take the middle of the road, the federal projections, we can see that at the current trajectory, the debt to GDP is just going up and up and up. Let's switch gears and talk about Social Security. And before anyone holds their breath, we're going to be talking about a very positive change to Social Security. What happened at the beginning of this year was a law that was called the Social Security Fairness Act. And what it did is it eliminated the windfall elimination provision and the government pension offset. So if you worked for a job where you were not paying into Social Security, but you also worked, at least in some capacity, employment for a job that was paying into Social Security, or you had a spouse that was receiving a government pension, or you were receiving your own non-covered Social Security benefit, you're going to see a major increase. So some folks that are common that'll be seeing a big benefit are teachers, firefighters, police officers, or federal employees that were covered under the Civil Service Retirement System, or CSRS. And so the major benefit that you're going to get is twofold. One is that changes are retroactive going back to January 1st of last year. So if you were impacted, you're going to receive a lump sum, which is fantastic. And I'm going to skip ahead to a bullet point a little bit below. This is hot off the press. We got a notification from Social Security just hours before this presentation that these retroactive benefits will begin to be sent out immediately. Now, they are going to be doing it in phases. So if you check your bank account tonight or tomorrow, it may not be there. Social Security did send a note that they hope to get them all out through the end of March. So don't worry, don't call Social Security if you don't have it, but by the end of the week, they're in the process of issuing those lump sum payments for the retroactive benefits. Another big component here is this applies to spousal and survivor benefits. So let me explain a scenario that may impact a majority of our clients here. If you have the husband who was a teacher that was working in the para system, and then you have the wife who was working for a job that was covered in Social Security. The husband was not able to receive a spousal Social Security benefit because his para benefit was so high that the Social Security was essentially reduced to zero. That is no longer the case. So now the husband will be able to apply to Social Security for a spousal benefit on the wife. So this could amount to, depending on what the reduction is, $1,000, maybe $1,500 extra a month going to you. And this will also have implications for survivor benefits as well. So if you never applied for Social Security because you thought you would not receive a benefit, we recommend that you apply as soon as possible, because you may be entitled to 6 months of benefits retroactively if you should have done it earlier. Because remember, these retroactive changes went into effect from January 1st, 2024. If you have any questions about this whatsoever, please call us, please send us an email. We want to be your resource for you, because contacting Social Security right now might be a little difficult due to the amount of folks that are getting in touch with them due to this really great and surprising news. And just the last 2 points are so important, I want to say them again. Retroactive benefits are going to start to be paid immediately, and Social Security in their communication said that it'll probably happen through the end of March. And then you will start to see higher payments be reflected in April. So if you were a part of the windfall elimination provision or government pension offset, your monthly benefits were being reduced. So once that reduction is stored away, you will start to see those higher payments going on a go-forward basis beginning in April. Now let's talk about interest rates, housing, and the Federal Reserve. What we're looking at now is the federal funds rate, and it goes back roughly 10 years. And you can see that in recent years, we had a big increase here in the federal funds rate, and then it started to come down lately. The reason why the Federal Reserve started increasing rates from zero, roughly in 2022, is to try and cut down inflation. Inflation in 2022 had peaked at roughly 9%. And so the Federal Reserve needed to do something to counteract that. So one of the ways that you can tackle inflation is to increase interest rates. And the way that interest rates impact the economy is they essentially slow it down. That is really what they're trying to do. They're trying to convince folks to not spend and save more, and so they can pull dollars out of circulation. But now that inflation seems to have been tamed a little bit, you saw the Federal Reserve last year decrease interest rates a few times. However, inflation is still not quite at their 2% target. Depending on what measure you want to follow, it's maybe somewhere in the high 2s or even low 3s. So at the very last meeting they had, the Federal Reserve Chairman, Jerome Powell, came out and he said the Federal Reserve is in no rush to lower interest rates from here. However, you do have the bond market anticipating that the Federal Reserve will lower interest rates possibly 2 times this year, and they would possibly lower it 0.25% each time, or sometimes refer to it as 25 basis points. So the market is anticipating that the Federal Reserve lowers interest rates this year by 0.5%. We will see. I think they're going to be paying very close attention to some of the economic policies coming out of Congress, as well as the executive branch, and also keeping a very close eye in terms of what is ultimately happening with inflation. But in terms of interest rates going down from here, the Federal Reserve was very clear that they are in no hurry to make any further changes. We're often asked, in the same vein as what's happening with interest rates at the Federal Reserve, what's happening with mortgages? When do you expect mortgages to come down? Is now a good time to refinance? When do you think will be a good time to refinance? What do you think about housing? And so mortgage rates, and you could see in this chart, actually operate independently of what's going on with the federal funds rate. And in recent history, we've actually seen them work in opposite directions. So as you might recall from the last chart, in the fall of 2024, the Federal Reserve started to decrease interest rates. But at the very same time, you saw mortgage rates begin to pick up. And this is a very important point, that even if the Federal Reserve does lower interest rates 1 or 2 times this year, that does not necessarily mean that mortgage rates are going to go down. Mortgage rates are much more influenced by how the market perceives inflation and long-term economic growth. And so it's not as easy to predict what's going to happen to the 30-year, fixed mortgage rate. It's certainly not easy to predict the federal funds rate, but in terms of how the market is going to be anticipating this, it's yet to be seen. Ultimately, getting inflation under control, moving in the right direction, I think is going to be a major part of this. And ultimately, we do think that if the United States is at least able to start chipping into what our annual deficits look like, that would also potentially play into this in a positive way.
All right.
So now let's get to you. Well, why don't you go ahead?
Oh, okay, Sam. I'm sorry. I'm going to jump in. Just going to talk about this slide and the next one. Just talk about some of our additional services. Now, the reason I wanted to call your attention to this, lately we've been getting a lot of questions asking about financial planning. This is something, actually, this is a slide taken directly from our website. It speaks to the financial planning that we do for our clients, and it's available to each and every one of you in terms of retirement planning, financial planning, reducing taxes. Other additional services include Social Security analysis. Sam spoke to that. Please utilize us as a resource. We are more than happy to help. Also, we have Medicare planning services in terms of shopping the marketplace, providing additional services to you as well. And I would just make a last comment, retirement income analysis, to make sure that you're on the right track, to make sure that your strategy is going to work not only now, but in the future long term. So please let us know if this is of interest. We can put together a plan and a strategy specifically designed just for you. All right, Sam, why don't you take the next one?
All right. Some of these planning strategies you've seen us talk about before, but I want to spend a little extra time on the first bullet point because this is new as of this year. If you are 60, 61, 62, or 63, you have the ability to contribute even more to your retirement plans than you have in the past. Everyone for their 401k in 2025 has the ability to contribute $23,500. If you are over age 50, you are entitled to a catch-up contribution of $7,500. So if you are over age 50, you can do $31,000. The kicker is if you are 60, 61, 62, or 63, you can do even more than that. There's another special catch-up just for you because you're special. I don't know why it's only those 4 years. You'd have to ask favorite person out east why that is the case, but this is something new. So we're often asked, how can I find ways to save more and do so by reducing taxes? Well, you know what? If you're 60, 61, 62, or 63, we now have the ability to do that. So let's start taking advantage of it and let's strategize on how we want to go about saving even more. Another great strategy is contributing to a health savings account. So you are able to contribute to a health savings account if you are enrolled in a qualified high deductible health plan. We talk about HSAs and recommend HSAs because it is one of the most beautiful vehicles out there because it's triple tax exemption. When you contribute to an HSA, it is tax deductible. The money is able to grow and be invested, which we can help you with, tax deferred. And when you pull it out for a qualified medical expense, it comes out tax-free. So it is not taxed at any point along the line. And so these are great vehicles when you have the ability to use them. Now, even if you don't use it for a qualified health expense, if you're over age 65, you can still use it for other living expenses as well, and you are not incurred a penalty. You are, however, taxed if you don't use it for a qualified health expense. So this is also another opportunity for you later on in retirement to use it as a potential vehicle to fund it under needs if necessary. But obviously we want to try and avoid that. The next item that we want to bring to your attention again is tax smart distributions from inherited IRAs. There was a tax law that passed in 2020, which changed all of the rules for inherited IRAs. It essentially gave non-spouse beneficiaries, with some exceptions, but non-spouse beneficiaries 10 years to withdraw the entire amount within a traditional IRA. So we don't want to wait until year 10 to start these distributions. We want to smooth it out over your particular tax bracket, and we want to be very conscious of it. There's also another change that went into this tax season that we also want to make you aware of. We're doing this on the back end, but want you to be aware of what we are doing. If the person who was the original owner of the account passed away after 2020, and before they passed, they were taking their RMDs, that now means, as of this year, that you must take an annual RMD yourself in addition to the 10-year rule. So we want you to be very aware that you're going to have to start taking out distributions on an annual basis, even if you don't want to. So planning is now more important than ever. Roth contributions, qualified charitable distributions, also great. And then lastly, want to be able to sit down and, if it makes sense, talk about alternative investment strategies. This is not a recommendation in either of those two areas. We're asked about them pretty frequently, so we want to invite you to have a conversation with us to see if it might be a good fit, because these are not going to be a good fit for everyone. Often we reference market history and we use averages, but I think the word average could potentially be a little deceiving sometimes, because average average year isn't so average. So if we're looking at the S&P 500 from 1950 to 2024, the average annual return falls somewhere around that 9 to 10%. But if we look back over this 70 plus year history, we see only 4 times has the market actually fallen within that 8 to 10%. So what we're trying to say here is, when things are good, generally the market is actually doing above that. And of course, you can see the down years, which is how we ultimately arrive at the average. So the comment here is there's no such thing as average. There's volatility no matter where you're at, and just want you to be prepared that we talk about long run returns in the long run, but over short periods of time, it can be very volatile. This is one that we probably could have included at the beginning part of our presentation too, but the main point that we want to emphasize, and what we are always doing for you, is we are separating politics from sound investing principles. Going back to Kennedy in the 60s, we're looking at how the stock market has performed under Democratic presidents and Republican presidents. Along the way, there's been many different policies, there's been many different strategies, there's been booms, there's been busts, there's been wars, there's been all these other events that have ultimately happened. But what you can see is that regardless of the political party, we are seeing the stock market continue to rise. So however you're feeling, particularly about the political climate right now, we just want to emphasize that having a sound investment principle and removing politics from the equation is really the way that we can best set you and your loved ones up for the future. If now does not feel like a great time for you to be invested in the stock market, we want to give you an alternative. And the alternative is the United States Treasury bill, which we refer to as a T-bill for short. The T-bill is backed by the full faith and credit of the United States government, which is why it is often given the nickname in our industry as the risk-free rate of return. When you buy a treasury bill, it has a fixed interest rate. So let's take the 6-month T-bill rate, for example. If you are to buy a 6-month treasury bill, the annualized rate on that is 4.33%, and that does not change. Whereas when you're invested in another bond or a bond fund, that is ultimately going to fluctuate. The treasury bill is also more tax advantaged. There is no state or local taxes on the interest. So this is different than interest in a regular bank account, money market account, or a CD. When you have a CD, the interest is taxed at the federal, state, and local level. With the treasury bill, it's only taxed at the federal level, so you get a little bit of an after-tax boost. And lastly, and this is a huge difference from the CD, your money is available without penalty whenever you need it. So in this example, let's say you bought a 12-month treasury bill and you need it in 6 months. Great. We're able to sell it and give you the exact value that it is on that day. Conversely, with a CD, if you bought a 12-month CD and you need it in 6 months, the bank is going to penalize you anywhere from 3 to 4 months interest. So the treasury bill gives you that added flexibility in addition to being more tax advantageous. And then the final kicker is that it is the safest investment in the world because it's backed by the full faith and credit of the United States government. So if you have cash that's just sitting at a bank doing nothing, or even if it's in a CD in some cases, let's get it into a treasury bill so it's working productively for you. So now I'll turn it back over to Jordan to talk about some important reminders.
Okay, thank you, Sam. So as we always encourage everyone to schedule a review consultation, we are available, we are ready and willing and looking forward to talking with you. We can meet in person, we can talk over the phone, or we can schedule a Zoom call, whatever's most convenient for you. Please let us know, please reach out and schedule your review consultation right away. We've had a number of questions regarding tax documents. If you haven't received all your tax documents, you will receive them by the end of this week. If you still have questions, reach out to our office. We'll be happy to email them to you, print them, send them regular mail, whatever is best. Number 3, can't emphasize the importance of reviewing beneficiaries. We see this happen all the time. It's already the 3rd week of February, and I can't tell you how many times someone has updated their beneficiaries because they were outdated. Please let us know. Let's take a look at that together, and we can make the proper updates. And last but not least, cybersecurity. Please be careful of scams, especially during tax season. These scammers are in hyper mode. Please be vigilant. Please be careful. If there's any questions or concerns, reach out to us. We will put extra security precautions, which we do already, but let you know that we will be even more careful if we're made aware. Now, as I mentioned in the beginning, if you do have a question, please email us at info@dechtmanwealth.com. We do have some time to take a few questions, and we'd love to hear from you. And if, yeah, please let us know. And we want to say thank you while we're waiting for a few questions. Any questions? Sam, do you have a question that you see there?
Yes, I see one coming in right now. Okay, this is in regards to Social Security. I've seen different reports that they're going to cut my Social Security benefit. Is it still going to be around? This is actually a question that we get asked quite regularly, and Jordan and I and
Yeah,
Adam and everyone here at Dechtman Wealth Management can say with pretty good certainty that your Social Security benefit is not going to be cut. We do not believe that Social Security is going to be impacted in a negative way. In fact, over tonight's presentation, we talked about two very positive benefits about increasing benefits. One was in regards to the implementation of the Social Security Fairness Act, and the other was the proposal that there might not be any taxes to Social Security. The government at large does not have very many popular agencies and systems to it, but Social Security is actually something that most of Americans really do like and support. And there's roughly 70 million Americans that are receiving Social Security. So I am of the opinion, and Jordan's of the opinion, that the vast majority of those folks vote, and they're probably not going to be voting for anyone who's talking about reducing their benefit. So when it comes to right sizing the government, we do not believe that your Social Security benefit is going to be negatively impacted. That's not something that we think is likely.
agreed. And I would concur. That's a political hot potato, and neither side of the aisle wants to touch that, and they are not going to touch it. So rest assured, your Social Security, your Medicare is safe and secure. Okay. I think we have one other.
Actually see it.
Yeah, Sam, you want to?
Yeah, so this is in regards to, I think it's sort of in a similar vein. It's asking about the treasury bills. This is saying, are you worried about the treasury bills given the different cuts to the government? So let me explain that one. The short answer is no. We are not worried about treasury bills paying out. We still think that the United States government will do that without question, and there's a major incentive for them to continue paying out on the treasury bills. So as we discussed in a previous slide, the national debt is 36 trillion with a T. And so at the moment, we are still running a deficit, meaning that we are spending more than we make. So at the moment, we're still issuing new treasuries to pay for existing bills. So the last thing that the government wants to do is to put any worry in investors' mind that they're not going to continue paying out on the treasuries. Because quite frankly, we vitally need them to continue just operating as is. So there's a major vested interest in the United States to never put a worry in investors' minds that we're not going to be able to pay that, because quite frankly, we need to do that to continue operating all of the different services that we do at the moment. So the treasury bills are very short-term in nature, and we have no reason to believe that that won't be something that's of major importance and one that we think is not questioned.
Absolutely. We do have one last question, and then we're available anytime. Please reach out to us. The question is, as far as the presentation itself, something I did not mention in the beginning, we are recording this presentation. We are going to send you the entire presentation and the slides sometime next week. So you will have full recall, and you can see everything that was discussed here today. And of course, we want to meet with you, review your specific questions and concerns. Sam, I think we got one more question, and then we're gonna end our discussion here. Are there any plans to increase the age for full Social Security retirement qualification? I'm assuming that that is always a possibility. That being said, it's not on the table that we know of at this moment. Sam mentioned that we get Social Security updates almost on a daily basis, and we got an update just hours before today's presentation about the GPO and the WEP. Um, But the moment we hear something, we will let you know. And that's our job, to educate and inform and to help you and your loved ones now and in the future. On that note, I'd like to say thank you all for attending. We wish you all a very good evening. Look forward to talking to you soon. Thank you so much.
Thank you.